What happens before a market crash? It's one of those questions that follow you the moment you put your first dollar into the market. Because deep down, every investor has the same fear. What if I wake up tomorrow and everything I've built, my savings, my investments, my future, suddenly disappears? But here's the truth most people never hear. Market crashes never come out of nowhere. They don't strike like lightning. They don't sneak up silently in the middle of the night. Before every crash, every single one, the same four patterns appear. From the Dutch tulip collapse of 1637 to the Great Depression of 1929, Black Monday in 1987, the global financial crisis of 2008, and they're showing up again today. So in this video, we're going to travel across nearly 400 years of financial history, through bubbles, manias, revolutions, and collapses, to uncover the four signals that always show up before a crash. To understand the future, we start with the very first recorded market crash. A crash so old it predates Wall Street, computers, and even the combustion engine. So hit subscribe, and let's get started. Part 1. The flowers that broke an economy. Our story opens in the Netherlands, in the year 1634, an era when the country was rising faster than almost any nation in history. Fresh off its independence from Spain, the Dutch Republic had become a global powerhouse. Its ships, under the Dutch East India Company, ruled trade routes that stretched from Europe to the far edges of Asia. Spices, silks, porcelain wealth from every corner of the world flowed into Amsterdam's canals like a rising tide. Merchants grew rich, cities expanded, and with this new prosperity came something timeless, something that still drives markets today: the desire to show status. But status didn't come in the form of gold or jewels. It came in the form of a flower. Tulips, exotic, vibrant, and extraordinarily rare. Imported from the Ottoman Empire, tulips weren't just beautiful, they were difficult to cultivate and almost impossible to mass produce. Owning one was like wearing a luxury watch in today's world, part fashion, part flex, and entirely a symbol of having made it. Historians estimate that a single pound of tulip bulbs could sell for what amounted to a month's salary for a skilled worker. In today's terms, imagine paying over $3,000 just for a handful of flowers. But markets behave the same way across centuries. Once people see something rare and desirable, they don't just admire it, they trade it, they speculate on it. They convince themselves that the price will rise forever. That's exactly what happened in the 1637. To meet the exploding demand, the Dutch created one of the world's earliest futures markets contracts that allowed buyers to lock in a price today for tulips they would receive months later. And as tulip prices kept climbing, those contracts became incredibly valuable. If you could secure a contract for the equivalent of $3,300 today and resell it when prices hit what would be $30,000, you didn't need to grow a single flower. You just needed someone else willing to pay more. Soon, people weren't trading tulips at all. They were trading the promise of tulips. Paper changed hands faster than bulbs could bloom. The mania fed on itself. Families mortgaged land. Merchants abandoned their trades. Some tulip varieties soared to prices equal to 5 years of an average worker's salary, the modern equivalent of buying a home just to own a flower. But markets built on hope have a fatal flaw. Hope has no floor. One winter morning, buyers simply didn't show up at auctions. No panic, no warning, just silence. And in that silence, everything unraveled. Contracts that had once symbolized wealth instantly became worthless pieces of paper. Prices collapsed overnight. Fortunes that took decades to build evaporated in days. The world had just witnessed the first documented market crash. And from that crash emerged Pattern 1, a pattern we will see again and again throughout history. Investor overconfidence. Speculation detached from reality. The belief that prices can only go up. A belief that would return centuries later, bigger, louder, and far more dangerous. Before we step into the Roaring '20s, don't forget to subscribe so you don't miss the rest of the story. Part 2. The greatest crash in American history. Fast forward nearly 3 centuries from the tulip markets of Amsterdam, and we land in the United States during one of the most glamorous, electrifying decades in modern history. The Roaring '20s. America was transforming. Electricity lit up homes. Automobiles turned long journeys into weekend outings. Radios carried music and news into living rooms for the first time. It felt as if the future was arriving all at once, and it was arriving fast. With innovation came wealth, and with wealth came a new obsession: the stock market. Stocks weren't just for bankers or industrialists anymore. Teachers, factory workers, shop owners, everyone wanted a piece of the prosperity. Newspapers told stories of ordinary people becoming rich almost overnight. It was the American dream, condensed into a ticker symbol. But beneath the glow of optimism, something dangerous was taking shape. A financial invention spreading quietly through Wall Street. Leveraged investment trusts. On the surface, the idea seemed brilliant. You put in $1. The trust then borrowed another dollar, sometimes several, and invested it all together. If the market rose, your gains multiplied. If the market fell, well, that part wasn't mentioned as loudly. Leverage is like gasoline. It makes everything move faster, including the fire. As more of these trusts launched, something bizarre and deeply troubling happened. Their valuations began rising far beyond the actual value of the stocks they held. Imagine paying $200 for a fund that owned only $100 worth of assets. That's how disconnected from reality the market had become. So where were the regulators? Mostly standing on the sidelines, watching. This was the era of laissez-faire, the belief that markets should be left alone, free to grow, free to innovate, free from interference. Politicians didn't want to disrupt prosperity. Banks operated with enormous freedom. And the public believed the market could only move in one direction, up. Then came the 24th of October 1929, a day history remembers as Black Thursday. At first, it was just a sharp drop. Then another. The market didn't just fall, it unraveled. Panic spread. People rushed to sell. No one wanted to buy. And the decline didn't stop for years. By the time the dust settled, the stock market had lost 89% of its value. Unemployment soared to 25%. Banks collapsed. Families lost their homes. Soup lines stretched across city blocks. This was the single greatest financial disaster in American history. And behind it stood pattern 2, regulatory shortcomings. When new financial products grow faster than the rules meant to keep them in check, when innovation outruns oversight, instability builds quietly, invisibly, until it becomes impossible to contain. In response, the U.S. introduced sweeping reforms: the Glass-Steagall Act, FDIC insurance, and modern banking regulations. These guardrails reshaped the financial system for decades. But as history would later show, rules alone cannot prevent the next crisis. Not when human psychology, innovation, and risk are pushing the boundaries once again. Part 3. The algorithm that broke the market. By the mid-1980s, Wall Street didn't just feel like the center of American finance, it felt like the center of the universe. The decade was loud, fast, and unapologetically greedy. Bankers who once worked quietly behind the scenes were suddenly household names, earning bonuses that dwarfed anything from previous generations. The trading floor became a battlefield, and the new weapon of choice wasn't instinct or experience, it was the computer. Algorithms were entering the world of finance, promising precision, speed, and a kind of mathematical discipline that human traders could never match. And out of this technological optimism came a financial invention that would change everything: portfolio insurance. The idea sounded flawless. A clean, elegant formula designed to automatically protect investors from big losses. If the market dipped, computers would slowly sell off portions of a portfolio, not enough to cause panic, just enough to cushion the fall. It was marketed as a seatbelt for your investments, a tool that would keep you safe in a downturn. By 1987, more than $80 billion was being guided by this strategy, a staggering sum for the time. Investors trusted it. Banks trusted it. Even regulators saw no reason to intervene. What almost no one asked was the most important question. What happens when everyone uses the same perfect strategy at the same time? Meanwhile, the market was being whipped into a frenzy of leveraged buyouts and aggressive corporate takeovers. Rumors alone, even completely fabricated ones, could send a stock soaring overnight. Greed wasn't just present, it was celebrated. Confidence wasn't just high, it was blinding. And in October 1987, the first cracks appeared. The market began to slip. Not crash, just drift downward, the way markets naturally do from time to time. But the computers didn't see it as a natural drift. They saw it as a signal. With each tiny drop, automated programs triggered small sell orders. And those sell orders pushed prices down further, which activated even more selling, which triggered a cascade of additional sell signals. A loop. A chain reaction. A negative feedback spiral accelerating by the second. Human traders watched in disbelief as screens flashed red. Some saw hundreds of thousands of shares flooding the market with no buyers in sight. The very system designed to prevent disaster was now locking the market into a death spiral. On the 19th of October 1987, the day now known as Black Monday, the Dow Jones collapsed 22.6% in a single trading session. To this day, it remains the worst one-day percentage drop in U.S. stock market history. And shockingly, it wasn't triggered by war, recession, political turmoil, or even bad earnings. It was triggered by a financial innovation that almost no one fully understood, yet everyone relied on. Pattern 3 revealed. A new, complex innovation spreads through the market faster than anyone can comprehend its risks, until those risks erupt all at once. And as history would later show, this pattern wasn't just a warning. It was a preview of an even more catastrophic failure 2 decades later. Part 4. The collapse that shook the world. Most people don't need a history book to remember 2008. The memories live closer to the surface than we admit. It was the year families loaded everything they owned into rented trucks and drove away before the sun came up. The year adults whispered about layoffs and foreclosures at the dinner table, believing the kids couldn't hear. Fear wasn't abstract, it was in the air. But to understand how the world reached that moment, we have to rewind to the early 2000s. After the dot-com bubble burst in 2000, investors were exhausted. Tech stocks had swung wildly and then collapsed. People wanted stability again, predictability, something that felt safe. And banks, always ready to meet demand, had just the thing. They introduced mortgage-backed securities, bundles of home loans, packaged together and sold to investors as safe, dependable assets. The pitch was simple. People always pay their mortgages. Housing prices always rise. This is the safest investment in America. And when investors wanted more, banks created something even more complex, collateralized debt obligations, or CDOs. These were layer upon layer of loans stacked and sliced into tranches with names like AAA-rated senior bonds, designed to look almost risk-free. But beneath the mathematical sophistication and glossy presentations was a truth no one wanted to face. Many of the loans inside these safe products were anything but safe. People were being approved for mortgages with no income verification, no savings, and no realistic ability to pay. Lenders didn't care because they weren't holding the loans. They were selling them off as fast as they could, collecting fees along the way. Rating agencies didn't care they were being paid by the same institutions whose products they were grading. Investment banks didn't care as long as investors kept buying. Investors didn't care, the yields were too good to question. And so debt exploded. Household debt surged as Americans bought houses far beyond their means. Corporate debt increased as companies borrowed cheaply in the low-rate environment. Banks levered themselves to the edge of the cliff, multiplying risk through layers of financial engineering. The entire system was built on borrowed money and denial. Then reality arrived. As interest rates rose and teaser loan terms expired, homeowners who had barely been scraping by began to default. Not a few millions. And because these loans had been bundled, mixed, and resold countless times, no one knew exactly who was holding the risk. What happened next was not a crash in the traditional sense. It was a chain reaction. Loans started failing. CDOs collapsed. Liquidity vanished. Banks realized they were holding assets they couldn't value or sell. Then came the moment that changed everything. Lehman Brothers, a firm that had survived the Civil War, the Industrial Revolution, and 2 world wars, fell. The shock was instantaneous. Credit markets froze. Companies couldn't borrow. Consumers stopped spending. Stocks plunged. Global trade slowed to a crawl. Entire economies were suddenly teetering. The world was pulled into the deepest recession since the Great Depression. And at the center of the wreckage was pattern 4, the buildup of excessive debt. The fuel that turns small mistakes into global catastrophes. Simple downturns into historic collapses. Debt had magnified the boom. And when the boom ended, it magnified the fall even more. When you step back and look across nearly 4 centuries of financial history, from tulips to trusts to algorithms to mortgage-backed securities, something surprising happens. The chaos starts to look organized. The randomness starts to look like rhythm. The patterns become impossible to ignore. The first pattern is investor overconfidence and speculation. It shows up when people stop caring about what something is actually worth and start caring only about what someone else might pay for it tomorrow. Values get replaced by vibes. Caution gets replaced by the feeling that everyone else is getting rich, so I should too. It happened with tulips. It happened in the Roaring '20s. It happened in the housing boom. And each time, the belief that prices must keep rising created the pressure that eventually brought everything down. The second pattern is regulatory shortcomings. Every major boom introduces something new. A new market, a new instrument, a new way to make money faster than before. But the rules meant to stabilize the system rarely evolve at the same speed. Sometimes they show up late. Sometimes they show up too softly. And sometimes far too hard. Whether it was the hands-off attitude of the 1927 or the slow response before 2008, the result is the same. A fragile structure growing taller than the foundations beneath it. The third pattern is a new, poorly understood innovation. A breakthrough appears, a product sold as safer, smarter, or more sophisticated than anything that came before it. Portfolio insurance in the 1986. CDOs in the 2000s. Complexity becomes a selling point, not a warning. But when investors don't fully understand the risks, and when institutions rely on the same models, the same assumptions, the same safe structure, what looks like innovation can become the spark for disaster. And finally, the fourth pattern, excessive debt, the accelerant that magnifies every mistake. Debt pushes prices higher during the boom, then pulls them down faster once the tide turns. It is the hidden multiplier beneath almost every historic collapse. These 4 ingredients don't guarantee a crash, but every major crash has contained all 4. And that brings us to the present. I'm not here to sensationalize. I'm not here to predict doom. And this isn't financial advice. But if you look closely at today's market, the old patterns are starting to whisper again. We see pockets of speculation in certain corners of tech, crypto, AI-linked assets, and meme-driven markets. We see regulations struggling, sometimes sprinting, sometimes crawling to keep up with emerging technologies. We see financial innovation spreading quickly, powered by algorithms, machine learning, and automated lending models that are still, in many ways, black boxes even to their creators. And debt, household debt, corporate debt, government debt, is sitting at or near record highs across the board. Does this mean a crash is coming tomorrow? No. Markets don't follow a clock. They follow behavior. but it does mean the system is fragile in familiar ways. And when a system is fragile, it doesn't take much to break it. That's why understanding these patterns isn't about predicting the next crash. It's about preparing for a world where cycles always return, even if the shape of each cycle looks a little different. History doesn't repeat itself. But as Mark Twain said, it often rhymes. The tulip traders of the 1,636, the investors of the 1,927, the quants of the 1,980, the bankers of 2008. They all believed they were living in a new era, too modern, too advanced, too rational to ever fall for the same mistakes. But the patterns don't change. Human psychology doesn't change. Debt doesn't change. Greed doesn't change. And that's why understanding these 4 signals doesn't just help you spot a future crash, it helps you stay calm, stay disciplined, and stay in control when others lose theirs. Because the real risk isn't the next crash. It's being unprepared when it arrives. We've seen bubbles form again and again throughout history. But I'm curious what you see in today's market. Where do you think the next bubble is forming? In AI, crypto, gold, real estate? Or somewhere we're not even looking yet? Let me know in the comments. I want to hear your perspective. If you learned something from this deep dive, make sure to subscribe. There's a lot more coming, and in a world that moves this fast, staying informed is the best investment you can make. This video is for educational purposes only. It is not financial advice, and nothing in this video should be interpreted as a recommendation to buy, sell, or make any investment decisions. Always do your own research